Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. I am your host, Dave Morja, and with me today is Paul Barbeau. Paul, welcome to the show.
Thanks for having me, Dave.
Yeah, I think this is going to be a good one. Like we kind of hinted before we hit record here, you kind of got a mix of properties. I'm sure it'll be exciting to see your background across all your different asset classes. But just for the listener, Paul is a multifamily and self-storage investor. He's based in Nashville. He started about 5 years ago and currently owns 96 apartments and 160 self-storage units. I'm just going to kind of let you take it from there, Paul, if you just want to maybe pick that apart and give us a little bit more of your focus and, what your background is.
Yeah, sure. So right now I've got two apartment complexes that are about they're actually each 48 units in two towns in Kentucky, actually, which are about an hour from where I am here in Nashville. And I've got two self-storage facilities in a small town in Tennessee. And so I kind of worked my way up to getting those from started out with a duplex I bought 5 years ago, and bought, sold, traded, scrapped, saved, everything you could think of to get to where I am today. And
So
yeah.
I'm going to make a half joke here, but was the criteria
Yeah.
for the multi to only buy 48 units or
Yeah,
how did that come to be?
it just so happens, I think they when developers build these things, they do them in fours, 16, 32. You see a lot of that, 48. But anyways, yeah, it just so happened that I got two 48s. So lucky 48, I guess.
And you mentioned kind of before we hit record,
Hmm.
a lot of your deals you said you're more less the lone wolf on. So I guess what
Yeah.
do you mean by that? What is your kind of involvement, with or without a team? You know, how you kind of run these deals. Maybe just get into how you closed a couple of these bigger multi deals.
Yeah. And so I guess when I say lone wolf, so right now I don't have any partners, but I definitely have a lot of team members that I use, which important ones would be your bank, your property management company, your my insurance company, my attorneys, and all that kind of stuff that goes into buying and managing these places. And then and actually my storage facility, well, storage facilities, they're, like I said, they're right across the street from each other, but I actually manage them on my own, and then the apartments are managed by a professional property management company. So yeah, even though I say I'm by myself, but I definitely do have partners, and I've had a a partner in the past on a multifamily deal, and it went well. A money partner, um, when I didn't have the funds to close it, found a good deal, and made some phone calls, made it happen. And so him and I partnered up and bought a 57 unit. And then other than that, yeah, I've had, hard money lenders and all that kind of stuff that definitely helped me out to get to where I am.
So I guess the contrast between the first two 48s and the 57 would be that capital raising partner. Other than just bringing in someone who has a different skill set, was there anything kind of through that learning process that surprised you? Was there, I'm sure, there's some other kind of skills that the partner brought to the table to close the deal, but
Hmm.
what did you kind of learn about dealing with someone at the partnership level? Because like you said, there's a whole team under you always, right? You got the PM group. You can't literally run that many units by yourself. It'd be darn near impossible. But what about like
Uh-huh.
relationships to that partnership level kind of were more of a contrast than you maybe thought going into that?
Yeah. So you definitely, your partners need to be people that you know, like, and trust. And even so I was actually his money, him and his wife's money. And so it was their money, right? And so I was responsible for taking care of it. And actually this my partner was actually a seasoned real estate investor. He had not broken into large multifamily before. At the time I owned a 32 unit. And so I kind of brought my skills and my comfort of, hey, I already own 32 units. Me and you can come together with your money, my I guess expertise, if you will, of owning a multifamily property, that's bigger than a duplex or something like that, to run it. And so he had owned single family homes and duplexes and that kind of thing, raw land, done some development stuff. But so he basically trusted me to do that. And he had the money, I had the skills. I found the deal. Um, and the deal also came with a bank, which was the owner, that wanted to finance if we brought 20% down payment, the owner was going to finance the 80% for us. And so basically I found those two things, and I said, hey, all I need is a partner with capital. And it was a big leap for me to, be responsible for that kind of thing. And so, anybody that's looking to syndicate or have a joint venture, raise capital, I'm sure the same things have gone through their head. Oh yeah, hey, we don't want to buy a crappy deal, to then you're going to lose money. And B, you want to be able to live with your partners for the duration of the deal. So I'd say that's, what you need to look for when you go out and find partners.
Yeah, well, that was kind of one of my thoughts was, sounds like you had a couple, trips around the block where you've operated a deal and done it exactly your way because you had kinda no one else telling you the way, to run it, not another kind of, voice in your head or, kind of partner with input. So
Yeah.
did that change on that next deal? And if so, like, how much did you have to change the way you operate a property just to make sure that everything was kind of peachy keen and rosy and everybody was happy involved in the deal?
Right. So I would um basically I'd look through our expenses monthly and say, and we would go through them together, at the end of the month, and say, hey, it looks like we're spending a lot here. What can we do? Or, hey, we're doing a lot of like we're hiring a lot of third party contractors. Maybe we want a good maintenance person to do X, Y, and Z to save us money. And so that was a lot of um, the conversations we would have about that stuff, and just really, really making sure that uh, the money wasn't going to waste. And but anyway, he pretty much trusted me and my judgment on a lot of things. And when our this deal in particular, it was a 57 unit deal, and it was definitely a value add play. The rents were um below market by about, I don't know, $150 a door. And so we'd go in, and when someone would move out, we'd go in and put new flooring, paint everything, put new light fixtures, and get the rents up, make the place nicer. And so we just had to figure out how to do that efficiently and economically to meet our goals.
Yeah, and so since the business plan involved, I guess what some level of trying to return capital from a partner, was the business plan different because of that? Because on a deal where you maybe ran it solo yourself, you might be okay with the lack of cash flow first couple of years or these types of things. So was there a different kind of call to action on this deal that you had to make sure you were aware of, that you otherwise didn't have to kind of answer to?
Well, yeah, it was a call to action, and then also kind of a wake up call, because him and I didn't know how much we were going to spend on the property to begin with. And so we did negatively cash flow for um, about a year, year and a few months while we were just taking all the money and putting it into the apartment. And at the time, we didn't know that we were going to be able to exit at what we did for, and we made really good money on it. But it was nerve-wracking at the time because we're like, oh man, we're spending all this money, and I was still new to the multifamily game too. And one of the things I did learn on that journey was, and then going forward, I do want to syndicate deals again, get joint venture partners, whatever, but is making sure you have enough money, A, that you borrowed from the bank, or B, that you raised from investors to make those repairs to get to where you want to get the property to where you want it to be, if that makes sense. So you're not in a crunch. And let's say you had 10 partners and you were like, oh crap, the bank account's looking a little low. Um, Go to these 10 people and they're going, well, no, this is, that's not what you said. You didn't say we're going to have to put more money into here, after the initial capital raise. So
Yeah, I guess the cardinal sin they say, right, is to use cash flow dollars instead of capex dollars on improvements, right? So if you're scheduling to use the cash flow dollars, you're probably not using the right bucket. Which
mhm,
if you're on your own deal, like you've done a couple of those where it's mostly just you have to respond to. You can get
mhm,
away with that. It's your own risk tolerance, no one to tell you no. But when you're using like you talking about either a partner or syndicating, which where you have many limited passive partners in a deal that you pretty much are advertising, you're gonna expect some level of cash flow to come back.
mhm.
There's a lot of risk that tilts there to pretty much say better raise for it first, right?
Yeah,
Yeah, so I was just
yeah,
curious to hear your takes on everything.
yeah. And it also depends on, some people say, well, how much money can you make with apartments? How much cash flow can I have with this this type of property, or this much down payment or whatever? And it's going to really highly depend on your loan, A, and then B, what kind of property it is. So I like to buy the C class value add properties. If you're buying an A class, where you only have to go in there and vacuum the carpets and touch up paint every time someone moves out, you're going to cash flow well, and you're not going to need the extra dollars. Um, and then also some people get interest only loans and all that stuff for periods of time, and that's definitely going to help your cash flow versus a fully amortizing loan where you're paying the interest and the principal from day one. You need to make sure that you're prepared to make those payments.
Yeah, me and my partner were looking at some old deals that transacted. And when I say old, I mean I think it was like some 2018 and 19 deals and a couple of our markets, just some deals that have pretty much came back to market with how hot it is. They're going up for sale.
Yeah.
Looking at the original loans, and even back then, it's crazy to see some of the IO terms and stuff you saw for some of the kind of bigger assets. It's interesting to see how people will bake in that IO term into their cash flow and then kind of almost move the risk tolerance on their deals. It's really interesting. Um,
Hmm.
but one of the things that struck me that you were just talking about um, was really the budget on these units and how it kind of walked away from you. Not necessarily walked away, but maybe you were expecting, more positive cash flow. Obviously, year one, likely, I'm assuming you plan to cash flow year one and that property. What did you learn from that? What was the kind of, economical learning as far as what to budget for these improvements? And what do you kind of target now when you talk about injecting capital into a unit and when you want to return that kind of money based on the rent bumps and all those things? So maybe just kind of dive there for a second.
Yeah. So I guess on the stuff that I've dealt with thus far has been mostly interior improvements. The exteriors have been good. I did have one of my 48 units that I put all new windows and doors in, did some landscaping outside, and I knew what that was going to cost pre-closing. But as far as the interiors, I usually budget about $4,000 or a little less for, and these are, my two bedrooms are about, I don't know, 800 or 900 square feet. One bedrooms would be like 600 or 700 square feet. And so your flooring, paint, light fixtures, maybe you're going to refinish some countertops. Maybe you're going to refinish some tubs, paint cabinets. But yeah, $3,000 or $4,000 a unit should get you there. And so if you multiply that by 50 units, you better have 150 to $200,000 um, ready to go. And then as far as return on investment for myself, I don't really have a good like metric like, oh, I want to make a X% return. But one of my like in my mind, I want it when I buy a property, I want it to in 12 to 18 months, I want to be able to refinance it, pull my capital out, and put that down on another property that size, basically. So I want it to make a baby, if you will, every 12 to 18 months, where I can, like I said, refinance my initial capital out and, the capital they use for improvements and go buy another one like that. So the BRRR method, buy, rehab, rent, refinance.
And
That's kind of my goal.
and you say you kind of haven't really got into syndication, at least, repetitively yet. With that
Hmm.
vision tied into syndication, is that something you would see your investor base 1031ing it into the next property, or would everybody kind of just exit with the refinance and then go into the next one if they choose to? How would you kind of manage that if you're to kind of go down that path where say everything works out, you get the 100% back out, what's the next steps there?
Yeah, I guess that would really just depend on my investors. If they said, "Hey, we want to hold this thing forever and have it cash flow," which is probably unlikely. Somebody's going to want to, "Hey, I want to go do something else with this money." So, you know, I would project like a 5 to 7 year hold, and then if we got an offer on the property that was absolutely spectacular, it was going to make a home run, make everybody a bunch of money, in year two, kind of talk to everybody and they're okay with selling it, then yeah, we'll sell. But yeah, if let's say it's a 5 or 7 year hold, probably refinance 18 months in to 2 years, and then go from there.
Yeah, obviously the year two refinance will lower a lot of risk regardless, right? Even if you can get, 60 to 70% of the capital back, your basis will be completely lowered and you can kind of sleep better at night as an investor in the deal, knowing that at least most of your capital is kind of returned home. Um,
Sure. Yeah. Yeah. And they're going to be happy,
y-
hopefully.
yeah, on the next exit, whether it's another refinance or a sale, what have you. Yeah.
Yeah.
Um, getting into the operations again. So I guess to get there, right? If your goal is to go 100% on the refinance and pull all the original invested capital out, that has to involve, pretty serious value add, not just like you said with the A class, not just like kind of paint and bump rents up from $1,000 to 1050 because that's not going to get you there, right? So you
Hmm.
mentioned it was about 4 grand to get that done for the units that you look at now in C class. What does that kind of get you on the rent bump side of things to be able to kind of get you that exit that you're looking for?
So that 57 unit I was talking about, my partner and I, so that got us the rents from, it was about $150 across the board. I think we took it from, don't quote me on this, but the gross income on the property was, I think it was like 350 gross potential income. So pretend like everything's full and you collect all the rents, from like $350,000 to like 400 and some change, maybe like $420,000 or something like that. And so you get that, and then divided by your market cap rate, and you've created at least several $100,000 worth of value on that property. And for that one, for example, we bought it for 2.5 million, put about probably like $150,000 into it, and then sold it for 4 million 2 years later. So that was a good little lick for us. And the market had also changed some. Like, cap rates have been compressing, I've seen in that market especially. So we had a little bit of tailwind along with the improvements that we made. But it was definitely, once you make the improvements, get the rents up to the market rate, even if you don't have a market change, or even if the market cools and the cap rates go up, which means, the next investor's not going to pay as much per, dollar made. Um, you know, that mitigates some risk, because let's say even if the rents went down some from what you were getting, you're still able to pay your mortgage, and you're still able to cash flow.
Yeah, and you mentioned kind of this market we're in. Well, I guess let me backtrack. Sounds like from napkin math, it's about sounded like about a 20% bump in NOI, and then plus like kind of the cap rate compression probably puts you right at where those numbers are. Sounds like obviously timing the market really well on that exit, I think, in my opinion.
Hmm.
So knowing that going into, the next round of deals where you're still targeting C class, where you're still targeting value add, and maybe the cap rate. I mean, I don't know if we all knew and we could make a bet, we'd be millionaires tomorrow, right? But
Yeah.
what is kind of your thought on how you're going to hedge against maybe, inflation going the opposite way, cap rates going the opposite way as they follow type of thing?
Yeah. And so that's definitely on my mind. I just bought, so I traded my portion of that 57 unit into one of my 48 units. And then, I traded another deal, which basically just bought 1031 it into another one, is what I mean when I say traded. But, and so, yeah, one of them I put, about, I think it was like 45% down on it. And so, in the past, I would always try to make my dollars stretch, 20% down, that kind of thing. So this one, I can definitely sleep better at night knowing that I have a larger percentage down. So if something happens in that asset loss value, then you know I'm still in a good position. Yeah, I lost my capital, but I won't be in a position where I can't pay off the bank note. Um, and then another thing I'm looking at is, so far I haven't used any like non-recourse agency debt, and I want to do that on one of those properties that I bought in March. I'm looking at mid next year, trying to get some agency debt, which which means great terms, um, lower interest rate than your local banks or traditional banks. A lower interest rate, you can lock in the terms for longer, I think up to 10 or 15 years sometimes. And then non-recourse, which you probably know what that means, but for the listener, that's if that property fails to perform, then you basically hand the keys over to the bank, and they cannot come after your personal assets. So if we have a big crazy downturn crash, I would lose my equity in the deal, but I wouldn't lose my other personal assets. So that's a huge deal. And that's why I'm looking into that. Not that I plan on it failing, but nobody plans to fail. But that does help mitigate a lot of risk to have the right type of loan in place for that.
Yeah, and yeah, they said, no one plans, but failing to plan to fail, right?
Hmm.
The only caveat with the non-recourse is obviously people tout those bad boy carve outs, or which are essentially saying as long as Paul you behave and try your best to run the property and aren't skimming money off the books and all these terrible things, which I
Right.
think that's an entirely different conversation to have. But as long as you're not doing that, they can't come after you. So yeah, some benefits there. And kind of going back to the IO, one of the bigger things on this recourse and more institutional debt is kind of just the terms that you'll get. Like you said, you'll get lower interest rates, but you can get IO for the first 3+ years. It's going to help your cash flow while you have the kind of pain of doing the capex. So,
Hmm.
I guess right before the PMI comes in, um, you can at least still cash flow a little bit while you're injecting money in the property and turning it over, which is a huge benefit, obviously, especially when you have kind of investors to raise capital for, or return capital to, rather.
Yeah, I was talking to a banker the other day, and he said, yeah, it's a Freddie Mac small balance loan was what he thought would be a good fit. And he said, yeah, you get 2 years of interest only, just automatically if you get that loan. 2 years of interest only. So, all right, party on.
Certainly makes it nice. The tough thing is, some people will go in with that, knowing that, and then turn around and want to do the business plan before the 2 years of IO is up. And hopefully you do some type of soft exit or full exit. And when you plan for that and underwrite for that, it can get tricky. So I would always suggest, talking to the listener here, just make sure you're writing the business plan to not rely on that IO. It's just kind of like a plus in the back of your mind, because it can be hairy. If your business plan goes slower or goes sideways when the debt comes knocking and you got to start paying a little bit more.
Right, right.
So Paul, I guess like what else in this space? You mentioned you're kind of starting to look to raise capital and look at some different types of loans. So is the focus to kind of partner more? Is it to do more of your own deals? What is the next couple quarters look like for you?
So right now I need to put some more of my own money to work. I will. I'm actually selling my self-storage facilities. Just actually got a working through a purchase and sale agreement right now. And then I'll need to try to put that money to work, exchange it for either more self or other self-storage or more apartments. Just kind of depend on what comes up. And then yeah, I think I really would like to. I think my purpose and basically putting my skills to work for other people is going to be to raise money and help other people make money and retire. You know,
And you're kind of flirting into my five key questions here, which usually envelopes or unenvelopes kind of an entirely different discussion. So maybe we'll just kind of dig at them and I'll pick it apart these more. But as long as you're ready, I'd like to dig into these.
sure, go for it.
So the first one here, if you could only pick one trait that explains your success, what is that trait and why?
One trait, I think for me, that would be just showing up. And what do I mean by that? It's like, you know, basically you need to show up to meetings and you need to meet people. You need to answer your phone when people call, like get educated, go to conferences, be places when you say you're going to be, that kind of thing. I mean, I'm not the smartest person in the world, and I'm not the most like extroverted, and so I know that in this business you need to meet people to succeed. You need to meet brokers, you need to meet property managers, you need to meet partners, you need to meet other people in the business that you can just talk to about what you're doing and learn from. And one of my biggest things has just been literally just to show up and be present and learn
Yeah.
and take action, of course. But
Well, and that's the thing,
yeah,
right? That consistent action and more or less doing what you say you're going to do and putting the reps in on whatever your focus is. I mean, it doesn't have to just be multifamily acquisitions, but whatever it is, that's what's going to get you there. If you can kind of talk a big game, but
hmm,
putting in the reps is the big one. And just like
hmm,
for instance, like we met at a conference semi
yeah,
recently, um,
yep,
big movements like that. Like that's not like the craziest thing in the world to do, but just repeatedly putting yourself in an environment like that
yep.
creates an interaction just like this, right? So it's just kind of getting out there.
Yeah, even if you take baby steps, even the babiest of baby steps, once a day or once a week, if you wake up and read a little something, re- do something positive, yeah, eventually it's gonna contribute to your success, but just because it has to.
Yeah, absolutely. And it's almost like that what is it? That 1% compounded every day is like 23 times your original or whatever, some crazy numbers. Just like, yeah, the little additions, improvements, you'll get there for sure.
Yeah,
Um,
it's very, very true.
yeah. And then Paul, what is the most uncharacteristic thing you have done in your business and why did you do it?
Um, so I guess when I was first starting out, and we really didn't even get to this in the show, but I um I was working a full-time job. I was a construction manager, W-2 job. I made decent money, but I really, really I was educating myself. I bought a duplex that was a rental. I bought a house that I was living in, and I decided to quit my job and try to make it happen. Um, and so I was with literally no plan, no further deals in the mix. And I don't recommend doing that. But because there were some tough times there. Sold the house I was living in, sold my duplex, um, moved in with my parents, which is very humbling when um, I mean, I'm sure there's older people out there that it would suck worse for, but I was 27 years old at the time, moved in with my parents for about a year, and just did everything I could to make it happen and try to be successful in this business. So there was a series of steps that I had to take to basically get my first big deal, which was so I went duplex, uh, single family house, 32 units. So I worked and worked and luckily, knock on wood, I made it work, and I grew my business a lot faster than I ever would have thought, and a lot faster than I ever would have if I would have still had my job. Because when I quit my job, I had a little bit of knowledge, a little bit of expertise, but not much. But literally, just that almost a year of doing nothing but focusing on learning, trying to find deals, networking, making relationships, and that all ended up paying off in a big way for me, and I'm so thankful for that.
I'm gonna save my questions because this next one might kind of, blend into this one. So I'll just ask it. But can you
Uh-huh.
name a time where you felt like you weren't going to end up successful, and how did you overcome that fear? So pretty much, yeah, I'm sure it ties right
Yeah.
back to that.
Yes. Yeah, that was actually the time that and I'm not gonna lie, I went through some dark times back then. I actually thought that I was gonna have to go back to work, get another job, and so uh, during the day I would send like handwritten letters to. I thought I was gonna be a house flipper is what I thought I was gonna do. I bought this house in Nashville. I did a little bit of work to it, sold it, made decent money on it, and I thought, wow, that was easy. I'll do that again. And then I never found another house that was gonna work for me. Um, but anyway, so I was writing letters trying to find homes. Hey, I want to buy your house, and I was really, really hitting a wall. Really was down on myself. Like, oh, never gonna make this work. I feel like a failure. I'm sitting at home all day, every day. Nobody really understands what I'm doing. It's kind of like, oh, you want to be in real estate, but they haven't seen me do anything in months and months and months and months. Just looks like I'm just sitting around. And so I really got down on myself during that time. But it, it- you know, even I was thinking I wasn't going to succeed, and of course, everyone around me, thought the same thing. And then I started applying for jobs. Uh, didn't get any interviews, but then and I started actually working construction for my cousin, and I have a master's degree. Here I am. I used to make good money. I had this great job and lived in a nice place, and then all of a sudden I'm working a $15 an hour construction job. So yeah, it was rough times, but like I said, all that stuff that I was doing during that time paid off
Yeah, anytime,
well.
yeah, anytime the results don't necessarily line up with kind of the repetitions you're putting in, it can kind of be that like battle, right? It's like,
Hmm.
I'm doing the things like I know I'm supposed to be doing to get this done. It's just like not
Yeah.
happening yet. It can be very,
Yeah.
very tough, especially like you say, if you kind of got to take a couple steps back to have that leapfrog forward. So yeah,
Hmm.
awesome that you were able to get through that.
Yeah.
Um,
It's like if you go to going to the gym for oh, I've been going to the gym for 2 months and I haven't lost any weight. And then but it actually turns out that you gained muscle in that time, and you actually did lose body fat, but you did, you just feel like it's not working. I want to quit. So
and
yeah,
then
anybody
coming out, you
who's
got all this muscle that's going to burn the calories to burn the fat off later on. So you're actually better
yeah,
off. So
yeah,
yeah.
absolutely. So anybody that's out there that feels like they're struggling, you'll get there. Just keep pushing, keep learning, keep taking action, and you'll get there.
Yeah, absolutely. And then pretty much a flip to that one, Paul. Can you name a time where something in your business went perfectly, and what did you do to make that a reality?
Yeah, I guess nothing ever goes perfectly, but yeah, that deal I was talking about with the partner, I feel like that's one of my biggest accomplishments was, I had never raised money before. I had never, been involved with a property that large before. And like I said, we had our struggles and our scratching our head moments thinking, are we ever gonna make money on this thing? Like, you know, but it turned out really well, made good money for my investors, made good money for myself. And yeah, I'm proud of that.
Yeah, and it being your first kind of foray into that partnership slash raising capital, that's kind of a big one, right? It's easy, like I mentioned, it's easy to kind of just do your own deal and you don't have anyone to answer to, but
Hmm.
making it count on the one that needs to count, it's good. So congratulations there.
Yeah, thank you.
And then the last one here, what have you been focusing on lately to improve yourself or your business?
Yeah, so I kind of, and I guess everybody did during COVID, um, get away from going to the meetups, kind of, because we weren't meeting and there weren't conferences and there weren't anything like that. And so just like lately, I've been focused on getting back connected, getting reconnected with the people that I've known in the past, and be, hey, I'm still out here, like my brokers and just other investors in the area. And like I said, we met at that conference networking event a few weeks ago, and so my focus now is just getting back out there, getting visible, doing podcasts, and yeah, getting back into it because that's how you grow. Is And I thought, during COVID and even after that, when I was more comfortable just staying at home, watching Netflix or whatever, like, I'm doing okay. I don't really need to meet anybody new, but it does. It does help to drag myself out there, and I know it helps me just to be out doing stuff and learning and growing, and then and I know it'll help my business too.
Yeah, it can be well, at least for me, getting back into the in-person stuff because I'm in New York City, so it's a little slower
Hmm.
process up here for sure.
Yeah.
But the process of getting back and shaking hands in person has been maybe more tiring than I remember. Maybe it's just because I don't remember it as well, but it's a little
Yeah.
tiring, but at the same time very exhilarating because you just have so many great people you're meeting and so many ideas just kind of running through your head of what other people are doing. So it's just a good time, kind of like we had at that conference. Yeah, it's really exciting to get back out there, kind of like you're saying. So glad you're
Yeah.
doing the same.
Yeah.
Yeah, Paul, just really appreciate the time. Getting into kind of your background on deals, and just picking your brain at what you're looking to do, on the kind of, I guess, next iteration of your investment thesis, the next couple of years here. Really interesting to see how you're going to approach that. Sounds like the first kind of deal through that process is going really well. So, or has gone really well. So congratulations there. Just before we sign off, you want to let the listener know how they could reach you today if they wanted to partner, get in touch, kind of just pick your brain, anything like that.
Sure. So you can find me on LinkedIn. You can find me on Facebook, Paul Barbeau. Sure you'll have my name on the show notes and stuff. So yeah, hit me up, shoot me a message. I'll be glad to link up, answer questions, network, whatever.
Thanks again so much, Paul. Really appreciate it.
Thanks, Dave.
Thank you for listening to the show. I don't take your time and attention for granted and appreciate that you would spend it with me. If you enjoyed this show or any of my previous shows, it would be a huge help if you would rate and review the show on Apple Podcasts or your favorite podcasting service, or even just share the episode with a friend. And if you'd like help from me or would like to talk about real estate investing further, feel free to visit the show notes for more information, or you can visit davidtravis.com.